Okay, let's just jump right in. Think about this contrast for a second. The 1970s, you had inflation going way up, right? But unemployment was climbing too. Stagflation.
That nasty combination.
But then look at today. We've seen inflation spike, sure, but as it started coming down, unemployment, well, it hasn't really shot up in the same way.
It hasn't, and that's really counterintuitive if you remember your basic economics.
Exactly. It makes you ask, are we just repeating the 70s, or is something fundamentally different this time? That's what we really want to unpack in this deep dive.
Absolutely. We're going to explore that whole U.S. stagflation period in the 70s, what it was, what really drove it, maybe even bust some myths about how policymakers saw things then.
And then we'll bring it forward. Look at today's economy, see where the echoes are, the similarities.
But crucially, focus on the big differences, because understanding those differences is key.
Yeah, and we've got some fascinating sources for this. Articles, research papers. Some of them really challenge the standard story about why the 70s happened the way they did. Even sheds light on parts of the energy crisis you might not have heard.
Definitely some eye-opening stuff in there.
So our goal here is simple, really. We want to help you understand the nuts and bolts of 70s stagflation, see what's genuinely similar today, what's definitely not, and maybe figure out what lessons from back then actually apply now. Or maybe don't.
Sounds good. Let's start with the beast itself. Stagflation in the 70s. What exactly was it? Lay it out for us.
Okay, so stagflation is one of those portmanteau words, right? Stagnation plus inflation.
That's it. And in practice, it means you've got rapidly rising prices, high inflation happening at the same time as the economy is sluggish, not growing much, and unemployment is high.
It's like the economy gets stuck in mud, but everything's getting more expensive anyway.
Exactly. It's a really tough spot. And it kind of broke the simpler economic models, like the basic Phillips curve idea.
Right, the old trade-off idea, that you either had low unemployment and maybe higher inflation, or high unemployment and lower inflation.
Precisely. Stagflation blew that up because you got the worst of both, high inflation and high unemployment.
And the 70s in the U.S. really became the poster child for this. The Great Inflation, they call it.
Yeah, it wasn't just a blip. It was persistent, lasted for much of the decade. Now, a common story you often hear is that policymakers kind of chose this, that they were deliberately aiming for low unemployment and just accepted high inflation as the cost, based on that old Phillips curve thinking.
But our sources, they kind of push back on that, don't they? Quite hard, actually.
They really do. And this is where it gets fascinating. There's key research, particularly from Edward Nelson over at the Fed, looking at the actual historical record, the documents, the speeches.
What did they find?
Well, it suggests that idea of policymakers wanting high inflation to get lower unemployment is probably wrong, based on what policymakers were actually saying and writing at the time.
So wait, they weren't aiming for high inflation. What were they trying to do then? And why did it go so wrong?
The record shows they were actually aiming for low inflation, price stability. They talked about low single digits, even zero inflation. Arthur Burns, the Fed chair then, said that explicitly in '77.
Okay.
And they wanted full employment too, naturally. They wanted the economy running at potential. The problem wasn't their goals. It was their understanding of how the economy worked. Their model, their doctrine was flawed.
Okay, this doctrine. Tell me more. What was their economic map? How did they think inflation worked?
Well, from about 1970 onwards, certainly in the U.S. and the U.K. too, this non-monetary view of inflation took hold in official circles.
Non-monetary view, meaning not caused by money supply.
Essentially, yeah. They held some core beliefs that are pretty different from how most economists think today. They believe that cost push shocks, things like rising wages or raw material costs or energy prices jumping up, weren't just temporary blips. They thought these cost increases were kind of inherent, positive on average, and could drive inflation all by themselves, regardless of how much demand there was in the economy, even in normal market conditions.
So costs just naturally push prices up in their view, independent of anything else.
That was a big part of their thinking, yeah. And the implication of that view was huge.
How so?
Well, if inflation is mainly driven by these cost things, not by overall demand, then monetary policy, the Fed messing with interest rates and money supply.
It wouldn't really work against that kind of inflation.
Exactly. They thought monetary policy had very little leverage, maybe almost none, against cost push inflation.
Wow. You can actually see that in what they said.
Oh, absolutely. You look at the UK, Prime Minister Harold Wilson basically said he doubted any amount of slowing the economy down, any level of unemployment could stop inflation if it was being driven by these cost pressures. He just didn't buy that hitting the brakes would fix it.
So he rejected a core idea of the Phillips curve analysis.
Pretty much. And in the U.S., Fed Chair Burns, he acknowledged that, yeah, maybe excess demand back in the late 60s got inflation started. But by the 70s, he insisted it was these cost push factors keeping it going, quote, even under conditions of economic slack. He saw the Fed's job not as fighting those costs with tight money, but just making sure excess demand didn't make it even worse.
So their framework basically told them monetary policy was the wrong tool for inflation.
That's the core of it. If inflation isn't caused by too much money chasing too few goods, then tightening the money supply won't fix the root cause, in their view.
So what do they think would fix it?
Their focus shifted massively towards non-monetary tools, things that would hit costs and prices directly.
Like what?
Like incomes policies trying to control wages and prices, either with mandatory rules or voluntary guidelines. Also, administrative actions, industrial policies, even using tax policies specifically to push down on costs.
I remember hearing about wage and price controls back then.
Yes, exactly. Nixon imposed them for a while. And in the UK, you had ministers talking about how managing demand wasn't enough. You needed a permanent incomes policy.
And the argument is, because they were so focused on these tools,
they kind of took their eye off the ball with monetary policy. Their confidence, maybe misplaced confidence, in these non-monetary fixes meant they didn't realize monetary policy was getting too loose in the background.
So it wasn't deliberate neglect, more like a blind spot caused by their core beliefs.
That's the interpretations from the Nelson research. They weren't trying to create high inflation for jobs. They were trying for low inflation and low unemployment. But they fundamentally misread the cause of the inflation problem. And that led them away from using monetary policy effectively until much later. They just didn't grasp that sustained inflation over time really is a monetary issue.
That's a really different take than the usual story. It shifts it from a policy choice to a fundamental misunderstanding.
Okay, but that doctrine wasn't the only thing happening, right? There were huge external events too. The supply shocks. Oh, absolutely. The doctrine set the stage, you could say, made the system vulnerable. But then you had massive events that acted like pouring gasoline on the fire and contributed to the stag part, too, by disrupting everything.
The 1973 oil crisis being the big one.
The classic example. And it wasn't just market forces. It was triggered by geopolitics. The Arab-Israeli War in October 73. OPEC nations, the Arab members initially, used oil as a weapon, production cuts, an embargo against countries supporting Israel, especially the U.S.
Right, the infamous gas lines. That hit hard and fast, cut supply, drove prices through the roof.
Exactly. Global oil prices basically quadrupled in a matter of months. But it wasn't just political for long. Other OPEC countries, like Iran, saw the opportunity. The focus shifted pretty quickly to just maximizing revenue for the producers.
So a deliberate squeeze on supply, huge price hike, that ripples through everything.
Everything. Energy is fundamental. So that shock alone was a massive inflationary force. And it hit economic activity hard, too. And don't forget, even before 73, things were getting tight. The Suez Canal had been closed since the Six-Day War in 67.
Right.
And it stayed closed until 75. That forced oil tankers on the much longer road around Africa, added costs, added delays. So the environment was already kind of primed for trouble even before the 73 embargo.
Okay, so geopolitics messes with supply, jacks up prices. What about the money side? You said policy was too loose because of the doctrine, but what did that look like? Was money growth actually high?
It was, yeah. If you look at measures like M2, that's cash checking, savings, money markets, a broad measure, it was growing really fast in the early to mid-70s. Peaked near 15% year-over-year growth at times in the U.S.
15%?
Yeah. Now, the policymakers back then, with their non-monetary view, might not have seen that as the main inflation driver. But standard economics tells you if the money supply grows much faster than the economy's ability to produce stuff,
prices eventually have to go up.
Right. There's usually a lag, maybe a year or two, between big money supply changes and CPI inflation really showing it. But that expansionary policy, even if unintentional in its inflationary consequences, was definitely adding fuel to the fire.
And then there was Bretton Woods falling apart around the same time.
Yes, another huge piece of the puzzle. That whole post-war system of fixed exchange rates tied to the dollar, which was tied to gold, it basically collapsed in the early 70s, fully abandoned by the mid-70s.
What did that do?
Well, countries shifted to floating exchange rates. The dollar wasn't convertible to gold anymore for governments. It just introduced way more volatility. Prices for things traded internationally, like gold itself and definitely oil, had been relatively stable. Now they started bouncing around a lot more.
Okay.
Plus, the U.S. dollar actually weakened quite a bit in that new floating system. And if you're an oil producer selling your oil in dollars and the dollar's losing value, you're going to demand more dollars for your oil to keep your purchasing power. Exactly. So the end of Bretton Woods added another layer of price instability and upward pressure on commodities.
Wow. Okay, so you've got this flawed economic theory guiding policy, major oil shocks hitting supply, underlying money growth adding fuel, and the global financial system itself becoming unstable. It really does sound like a perfect storm.
It was.
But you mentioned something earlier, something really surprising, that the U.S. government might have actually encouraged the oil price hikes. That sounds completely backwards.
It does, doesn't it?
Yeah.
Because the narrative is always the U.S. is the victim of OPEC. But this source from the Institute for New Economic Thinking, digging into historian David Gibbs's work, paints a much more complicated picture. It argues the Nixon administration wasn't just caught flat-footed. In some key moments, they actually seemed to encourage higher prices, particularly from Iran and Saudi Arabia. They were sort of complicit.
Encourage higher oil prices. Why on earth would they do that? It was causing chaos at home. Gas lines, inflation.
Well, the motives seem to be this complex mix of grand geopolitical strategy, powerful corporate interests, and some pretty ambitious financial goals.
Okay, break that down. Geopolitics first.
A central figure here was the Shah of Iran. Nixon and Kissinger saw him as absolutely crucial, a key ally, a guardian of U.S. interests in the Persian Gulf. And Iran, according to Treasury Secretary William Simon himself, was one of the main countries pushing hard for higher prices within OPEC.
And Nixon supported that push.
The evidence is pretty startling. There's an account from Iran's foreign minister at the time reporting a message from Nixon to the Shah back in 1970, basically saying, tell the Shah you can push us as much as you want on oil prices.
Wow.
And apparently this wasn't just a one-off. Nixon and later Ford kept supporting the Shah's demands for higher prices. Treasury Secretary Simon apparently tried to get the Shah to ease up, but Nixon reportedly shut him down, saying, he's our best friend. Simon later said the U.S. never even hinted to OPEC that raising prices would hurt the relationship with the U.S.
And they even turned down help from the Saudis to restrain prices.
That's another incredible part of the story. In 1974, Saudi Arabia apparently offered to help block further price hikes if the U.S. would lean on Iran. But Nixon and Kissinger did nothing, just ignored the offer.
Unbelievable.
Yeah, the Saudi oil minister was apparently quite surprised, delicately noting that some Saudis were starting to suspect the U.S. didn't mind higher prices, maybe even wanted them.
Okay, so supporting Iran was a big piece. What about corporate interests?
Well, higher oil prices meant massive revenues for Iran.
Yeah.
And where did a lot of that money go? Buying U.S. weapons. Huge arms deals for companies like Northrop, Grumman, Bell Helicopter. Big profits.
Ah.
And, of course, the major U.S. oil companies themselves were seeing their profits explode thanks to higher global prices.
Yeah.
The U.S. ambassador in Tehran was reporting back in '74 that American businesses were doing great there. So a neat alignment between foreign policy and corporate bottom lines.
And the financial objective. You mentioned petrodollars.
This is maybe the biggest, most strategic piece. The U.S. was running big trade deficits, spending a lot militarily overseas. There were worries about U.S. debt, the dollar's stability after Bretton Woods collapsed.
Okay.
So the Nixon administration saw the flood of money going to OPEC countries from high oil prices as an opportunity. If they could get those countries to invest their huge surpluses, their petrodollars, back into the U.S., particularly into U.S. government bonds.
They could finance the U.S. deficit and prop up the dollar.
Exactly. It was a way to maintain U.S. financial power. And this led directly to this really significant and top secret at the time deal with Saudi Arabia in 1974.
The Saudi deal. What was it?
Treasury Secretary William Simon, who came from Wall Street, knew finance inside out. He engineered it. A secret agreement where Saudi Arabia, the biggest oil producer with mountains of cash, would buy massive amounts of U.S. Treasury bonds.
So the Saudis fund U.S. debt in exchange for what?
U.S. military support, political backing. It cemented their position regionally. And by holding so many dollar assets, they became heavily invested in the dollar's own stability. It locked them into the U.S. financial system.
And this was all kept quiet.
Very quiet for many years, only came out relatively recently. It was a major strategic play to ensure the dollar remained dominant after Bretton Woods.
And did other OPEC countries follow the Saudis?
They did. Once the Saudis started pouring money into treasuries, it sent a signal. Other OPEC nations started recycling their petrodollars into U.S. assets too. This huge inflow of foreign capital helped finance the U.S., yes, but it also told the world the U.S. was the safe place for money, reinforcing the dollar's global role.
What was the impact back home in the U.S. economy itself?
Well, the argument from the source is that this flood of petrodollars, while it worked financially for the U.S. government, had big domestic side effects. It massively boosted the financial sector, banks dealing with all this money, investments. It really accelerated this trend of financialization.
Meaning finance becoming a bigger and bigger part of the economy compared to, say, manufacturing.
Exactly. And some analysts argue this focus on finance, partly fueled by petrodollar recycling, contributed over the long run to the weakening of America's traditional industrial base. So yeah, the energy crisis wasn't just something that happened to the U.S. It was tangled up with some very deliberate, complex policy choices.
That adds a whole different dimension to the 70s story. Okay, so with all this going on, the flawed ideas, the oil shocks, the money growth, the end of Bretton Woods, even these deliberate policy moves, how did the U.S. finally get inflation under control?
Well, initially, as we said, that non-monetary doctrine really hampered the response. Policymakers were hesitant to jack up interest rates forcefully because they were scared of causing a recession.
Understandable, I guess.
Sure, but it meant inflation just got worse, and inflation expectations got really dug in. People and businesses just started assuming prices would keep rising fast, and they acted accordingly, demanding higher wages, raising their own prices. It became a self-fulfilling cycle.
Until Volcker arrived.
Exactly. Paul Volcker, becoming Fed chair in 1979, was the turning point.
The inflation slayer.
He basically was. He understood that breaking that cycle, especially the expectations, required shock treatment. It needed a direct assault on the monetary roots of the problem.
Which meant?
Aggressive, painful interest rate hikes. He pushed the Fed funds rate up to levels nobody had ever seen before. Close to 20% at the peak in the early 80s.
20%? That must have slammed the brakes on the economy.
Oh, it absolutely did. Volcker knew it would likely cause recession, and he was willing to pay that price. Borrowing became incredibly expensive. Investment dried up. Spending slowed. Companies laid people off. Unemployment shot up over 10% by early 83.
A deep recession.
A very deep and painful one.
Mm-hmm.
But it worked. That shock therapy finally broke the back of the high inflation and, crucially, convinced everyone the Fed was serious about price stability again. And it also marked a huge shift in thinking. After 1979, that non-monetary view that dominated the 70s pretty much abandoned. Policymakers, having learned the hard way, embraced the view that monetary policy is the key determinant of inflation over time.
Okay, that's a really thorough picture of the 70s. So now let's pivot. Compare it to today. We flagged the unemployment difference right at the start, but what else jumps out? Similarities, differences.
Well, one really striking thing, visually at least, is the path of headline inflation. If you graph the consumer price index, the overall inflation number, the shape of the curve in the last few years looks remarkably similar to the mid-1970s. In both cases, you see inflation shoot up for about 2 years, hit a peak, and then start coming down along a very similar-looking slope. The Rangvid source has a great chart showing this.
So just looking at that headline number, it feels like deja vu.
It really does. That figure one comparison is quite compelling at first glance. But, and this is a big but, when you look under the hood at what's driving inflation.
The components.
Yeah, the composition. That's where you see really big differences start to emerge.
Like what?
In the 70s, when headline inflation fell, core inflation, which strips out volatile food and energy prices, generally fell along with it. They moved down together pretty convincingly as the economy cooled.
Okay, and today?
Today, not so much. Headline inflation has dropped quite a bit from its peak, mostly because energy prices reversed. But core inflation, it's been much stickier, much more stubborn.
Still elevated?
Yeah. If you look at figure 2 in that Rangvid source, the fall in core inflation from its peak today is way smaller than the drop we saw in the 70s. It's hanging around at a higher level.
Any particular reason why core is so sticky this time?
A big one, highlighted in the sources and clear in the data, is shelter inflation.
Yeah.
Housing costs, rent, the implied cost of owning a home.
Still going up a lot, or not coming down fast.
Exactly. In the 70s, shelter inflation peaked roughly with overall inflation and came down with it. Today, shelter inflation stayed high for longer and is falling much, much more slowly. That persistence in housing costs is a major reason why core inflation looks so different this time around.
So the components are behaving differently.
Very differently. And it leads to this interesting debate. How useful is core inflation anyway? Economist John Cochrane, who's mentioned in the discussion, raises this point. Is core really a better predictor of future headline inflation than, say, just looking at past headline inflation?
What does the evidence say?
Well, analysis suggests maybe cores has had slightly better predictive power since the 80s, but the relationship is statistically pretty weak. The R-squared values are low, meaning core doesn't explain that much of the future variation in headline. So maybe focusing too much on core, especially when it's behaving so differently from headline and from the past, might not be giving us the clearest picture.
Interesting. Okay, so similar headline path, different core drivers, especially sticky shelter costs. Let's go back to that key difference we started with the Phillips curve, unemployment.
Yeah, this is probably the single biggest divergence. In the 70s, especially during the Volcker recession, the trade-off was brutal but clear. Inflation comes down, unemployment goes up. That traditional Phillips curve relationship held.
Painful, but predictable in a way.
Right. To cool prices, you had to cool the labor market, which meant job losses.
But this time,
This time it's been completely different. Inflation has fallen significantly from over 9% down towards, the 3% range, depending on the measure. Yet unemployment has barely budged. It's stayed remarkably low.
the labor market stayed strong.
Incredibly strong.
Yeah.
Which completely defies that 70s experience. It strongly suggests that relationship between inflation and unemployment just isn't working the same way today. The Phillips curve seems much flatter, or maybe something else is going on entirely.
Okay, so if the labor market stayed stronger this time, how did that affect people's paychecks compared to the 70s? Real wages.
Another huge difference, and a positive one this time, mostly. Real wages, what your pay can actually buy after inflation took an absolute hammering in the 1970s.
How bad was it?
Really bad. Nominal wages went up, sure, but inflation went up way faster, so purchasing power collapsed. We're talking drops in real wages of 4%, even 7 or 8% in some years in the late 70s, according to the data shown in Rangvid's Figure 8. That's a massive hit to living standards.
Ouch. Just falling further and further behind.
Exactly. A really tough time for households.
And today,
We felt the pinch from inflation, obviously.
we did, and real wages definitely fell for a period when inflation first surged. But because the labor market stayed so tight, nominal wage growth has been much stronger this time around.
So wages kept up better, much better. The drop in real wages was way less severe. The worst dip was maybe around 2% compared to those huge drops in the 70s. So while inflation hurt, the damage to actual purchasing power hasn't been nearly as deep or as long-lasting this time.
That's a crucial difference for people's everyday lives.
Huge difference. But there's a flip side for policymakers.
Oh.
This strong wage growth today, while good for workers, makes central bankers nervous. They worry that if wages keep rising quickly because jobs are plentiful, businesses will just pass those higher labor costs on as higher prices.
Making it harder to get inflation all the way back down to their target.
Exactly. It's a kind of cost-push concern again, but maybe driven more by labor market tightness than the sort of independent cost momentum they believed in back in the 70s.
So putting it all together, similar headline inflation path, different core stickiness, totally different unemployment story, better real wage outcome, but with this lingering wage growth concern. It sounds like a really complicated picture for policymakers today.
It absolutely is. Stagflation, or even just the risk of it, puts policymakers in that classic bind. Hit the brakes hard on inflation with high interest rates. You risk stalling growth in jobs. Ease up to support growth. You risk inflation flaring up again. The TrustNet source really emphasizes how difficult this balancing act is.
What tools do they actually have today, and how well do they work in this specific environment, given how different it seems from the 70s?
Well, monetary policy interest rates mainly is still the #1 tool for fighting inflation. But as we've seen, today's inflation had a big supply side element, right? Energy shocks, supply chain chaos.
Yeah.
And monetary policy mostly works on the demand side of the economy. It's less effective at directly fixing supply problems.
So it's a blunter instrument against some of today's issues.
You could say that.
Yeah.
And it brings that risk calculation into sharp focus. Hike too much, you could cause an unnecessary recession. Hike too little, inflation sticks around. That's why everyone hangs on every word from the Fed or other central banks, trying to figure out how they're weighing those risks.
Yeah. What about fiscal policy, government spending, and taxes? Can that help?
It can play a role, but it's often slower and the effects can be complex. The TrustNet source mentions things like windfall taxes on energy companies, like the UK did.
Right, grab some of those huge profits.
Yeah, the idea is to redistribute that to help consumers with bills. It offers short-term relief. But the downside, critics say, is it might discourage those companies from investing in more energy supply long-term, which could leave you vulnerable later.
Tricky trade-offs there, too.
Definitely. Governments can also try supply-side fiscal policies. Things like tax breaks for business investment, for R&D, for building infrastructure.
Trying to boost the economy's productive capacity.
Exactly. The thinking is if you can produce more stuff more efficiently, that helps ease inflationary pressure over the long run without just stimulating demand now. But the key words are long run. Those kinds of policies take years to really show results. They don't fix today's inflation problem quickly.
So if you're trying to navigate all this, maybe as an investor or just trying to understand the economy, what are the main takeaways from the sources?
Well, the trust net piece suggests a few things. First, definitely keep a close eye on central banks. What they say, what they do, it's crucial for understanding where interest rates might go.
Okay.
Second, pay attention to fiscal policy, too. Are there tax changes or spending programs that could specifically help or hurt certain industries?
Makes sense.
Diversification is also mentioned. In uncertain times, spreading investments across different types of assets, maybe considering things like commodities, infrastructure, dividend stocks, that sometimes hold up better in inflation, though nothing's guaranteed, can help manage risk.
Standard advice, but maybe more important now?
Perhaps.
Yeah.
And finally, think about the long term. Are governments actually making serious investments in things like infrastructure, energy security, boosting productivity? Even if the payoff is years away, those structural changes could really shape the economy down the road.
This has been incredibly helpful, really connecting the dots between that difficult 70s period and the confusing situation today.
Yeah, to sort of boil it down.
Yeah.
The headline inflation charts look eerily similar at first glance, but dig just a little deeper and you find huge differences. Core inflation behaving differently, that massive divergence in the Phillips curve, inflation down, jobs stay strong, and much better outcomes for real wages this time.
And that crucial lesson from the 70s wasn't necessarily about bad intentions, but about being guided by a fundamentally flawed understanding of economics, especially monetary policy's role.
Exactly. That non-monetary doctrine really tied their hands and let inflation get out of control before the painful correction under Volcker.
Which leaves us with a final thought, maybe something for you, the listener, to chew on.
Go on.
The 70s showed just how much policymakers understanding their underlying theory of the economy really matters. It shapes everything they do. So, given how different things look today, the Phillips curve, the wage dynamics, are we sure that the current frameworks, the current understanding policymakers are using, fully capture these new realities? Or could there be blind spots now, just different ones than in the 70s, that might make navigating the future trickier than we think?
That's the multi-trillion-dollar question, isn't it? Something to definitely keep thinking about.
Indeed. Well, thanks for joining us for this deep dive.